It's a pleasure to welcome Sam Weber here to talk with us about elements of investing that need to be thought about in greater detail. Thank you for being here, Sam.
Well, thank you very much for having me. It is my first interview, my first professional interview ever, so very excited to be here. What I recognized during the past 4 years is that many investors, or many people who call themselves investors, don't really realize that they are participating in the process of wealth creation, and they don't think deeply about what implications follow from that recognition. So, first of all, what I recognized when reading Steven Pinker's book, The Better Angels of Our Nature, is that many things in life follow a certain power law distribution. And wealth creation is one of the things that follows such a distribution. And there are many implications from that. First of all, what he explains in a very understandable way is that in order to get a power law distribution, you have to have two inversely related, overlapping exponential functions that develop over time. So I guess a good way to think about it is that companies, they create exponentially increasing profits, and the chances that a company survives over time are exponentially decreasing. I mean, you can think of it as if there is if the chance, the probability that a certain company goes bankrupt on every single day, if that chance isn't 100%, or if the chance that a company keeps surviving isn't 100%, then you have to multiply the probabilities of every single day, and you get an exponentially decreasing function over time with every additional day. So if you have the exponentially decreasing chances of survival and you have the exponentially increasing profits, you arrive quickly at such a power law distribution. And what I realized when thinking deeply about those distributions is that most of the wealth is created by a few companies. I recently attended this presentation by Joseph Stiglitz, where he said that 67 people in the world possess as much wealth as the poorest 3.5 billion, and most of that wealth comes from companies that created it. I also read recently in The Economist that 20 companies in Germany, France, UK, Switzerland, 20 companies pay 70% of the dividends. So you have this high concentration of wealth that is created by a few companies. And because you know that exponential interest is involved, and exponential functions, they need time to evolve. In the short term, exponential doesn't look very different from linear growth. So you have to have time, and you know that a few companies are responsible for most of the wealth that is created, and this tells me that focusing on high quality companies that exist for a long time probably allows me to participate in that part of the economy where most wealth is created. So I am very focused on owning high quality businesses for a very long time, what Charlie Munger calls sit on your ass investing. And there is a related topic that I think often about. It is the Anna Karenina principle that Jared Diamond explains in his terrific book, Guns, Germs and Steel. And what he explains in there is that many people tend to favor single factor explanations. But in order to understand success, it is very helpful to think of it as a confluence of many factors.
Lollapalooza.
Exactly. That's another way to think about the same thing, like the Lollapalooza effects. And what he also points out, what Charlie Munger indirectly only points out with his Lollapalooza effect, is that if you have one weak link, that weak link over time will kind of hinder you from having success. So it's difficult to predict the exact interaction between the success factors, but you know that if one of them isn't there, then over time this weak link will kind of hinder success from being established.
If we could focus on the first principle you're sharing with us, what I'm hearing you say is the strong get stronger, the big get bigger. Is that the concept that you're enunciating? Am I hearing correctly?
Yes, exactly. I think that there is the fact that you know that most of the wealth is created by a few companies that create exponentially increasing profits allows you to focus on the things that create most wealth. So if you look at it from a game theory perspective, there are the zero-sum games where you gain and someone else has to lose, and there are the non-zero-sum games where everybody involved can gain. And I think if you focus on high-quality companies who generate wealth over time, you participate in a game where everybody involved can win. You can be happy as an investor, the employees can be happy, customers get served well, suppliers get served well. It's kind of a non-zero-sum dimension. Whereas if you focus on special situations or distressed debt or many other kinds of cigar butt investing, what you gain in those situations often follows from a loss from someone else. So there are many different kind of dynamics involved, and I think it's one of the most satisfying and healthy ways to get rich over time is to focus on high quality companies.
This is a pretty profound observation, which probably didn't happen overnight.
Exactly.
So
yeah.
what was your process to kind of understand these multivariable Lollapaloozas and to understand that 20% of companies make 80% of the profits?
80-20 rule was one aspect of it.
Were there certain examples that you found and certain studies that you've explored?
Yes. Well, first of all, of course, I read The Intelligent Investor during my studies, during my bachelor studies actually. And then I just followed every advice that I got from Warren Buffett or Graham, or then I discovered Charlie Munger. I read his Poor Charlie Almanac, and what I recognized there is that he is really tackling those things in a very multidisciplinary way, with getting the big ideas from the different disciplines. So a very broad way of looking at things. And I think that kind of influenced me very much to think about those different models and dynamics and from different angles. And I didn't yet discover the power law distribution in Charlie Munger's set of tools, but I recognize that he's mentioning the Boltzmann constant. And what power laws, if you paint the size and the frequency of like cities or traffic jams or companies or whatever on a logarithmic curve where the x-axis is the size and the y-axis is the frequency, the things lie on a straight line, right? So I guess that has some relation to the Boltzmann constant that Charlie Munger mentions, but I'm not 100% sure if I got that right.
Yeah, so there have been studies suggesting that power laws apply to private equity. A handful of private equity shops make up all the profits of the entire industry. Mm-hmm. Power laws in terms of relationships, how a handful of people are connected to a very large number of other people. Mm-hmm. How have you applied power laws to your thinking?
Well, there are three main differences between power laws and like bell curve distributions, for example, and really Steven Pinker in his book, he explains that really in an understandable and very, very good way. The first thing is that there is no such thing as an average. You cannot speak of an average city or an average company. They come in many different shapes and sizes. I mean, if I would ask you how many inhabitants does the average city have, you would probably get many different answers from many different people. Then you have the so-called scale invariance, which means that the probability that something gets 10 times bigger doesn't change as it grows in size. And this is a very, very difficult concept to grasp, that those dynamics, I mean, there is the exponentially decreasing chance of survival, but as long as you're still there, you increase exponentially, and the probability of you surviving, if you look at it from a power law perspective, doesn't really change with size, which is I still have my troubles getting that concept right and transferring it to my investment analysis. And the third aspect of power laws is that you get those fat tails. I mean, if you read like The Black Swan from Taleb or many books about that topic, is that you get those really big things. You get those really big earthquakes, you get those really big companies, you get those really rich people, huge traffic jams. those are like, and they kind of destroy your average calculation. So you can calculate an average for a certain period of time, but then something really big happens which kind of influences the whole average that you calculated. So I think I always try to have those 3 observations in the back of my head and just look from situation to situation how I can apply it.
There certainly is a very strong power law mental model that has been very well observed. There's also the idea of mean reversion.
Mm-hmm.
And how do you think through these 2 different mental models?
Yeah, that's a very, very good question. Very good question.
And there's no easy answer. So
exactly.
But how do you try to combine these 2 frameworks?
Well, if I think at it now, I mean, what comes to my mind is that Charlie Munger says you have to have a checklist and you have to have different criteria for every situation. So it's really important to figure out where you are and if you can value or if you can get an opinion on where you are, and if you're not comfortable with your opinion you get, you just neglect it and focus on something else. So it would be very interesting theoretically to figure out the relationship between mean reversion and power laws, but instead of getting lost there, I mean, I like to think about it, but it's not something that I can solve right now, I guess.
And when you try to look for these companies which are outliers, which keep getting stronger, are there certain patterns that you see in these type of companies?
Yes, exactly. Exactly. I also wanted to answer that with your last question, but what I recognize is that many people don't really grasp the importance of high quality, of the confluence of able management, a really good track record, a known orientation by the management, and the need to pay a reasonable price for a company. So if those things start to work together and amplify each other, you really get those Lollapalooza effects, right? And sorry, I don't know if I really answered your question, but...
Yeah, so when you're looking to find these terrific high-quality companies which have power laws, which have Lollapaloozas, mm-hmm. and there's a very small number of these companies.
Exactly.
Are there certain checklist criteria? Are there certain processes that help you narrow the list or mm-hmm. help you get there quicker?
Mm-hmm.
It's a very specific type of thing you're looking for.
Exactly. So for me, a high-quality company needs to be very profitable, very high return on capital, very high return on equity, which means that the management works with the return on capital in a way that enhances return on equity and allows it to distribute a lot or to reinvest a lot in a profitable way. So you also have a high return on incremental capital. You have passionate management with a lot of emotional attachment to the company. You often have a lot of time spent in the company by the senior management, and you listen to what everybody that you meet or whatever you read, kind of what those person think of each other, and if they perform consistently over time, if what they say matches their performance, and if it stays consistent with time, if they focus on getting the reality right and not just to tell a story, but on really also changing with the environment and confronting reality up front. Like you in my experience, you get a certain feeling if you're dealing with a high quality company, and as soon as you get doubts about that, I think of the Anna Karenina principle, and I think the weak link, and I'm really careful about accepting deficiencies in quality, even if that means I have to pay a lower price. And many people feel comfortable owning mediocre to low quality as long as the price is low enough. And I think you're focusing then on one aspect of wealth creation that just isn't very important if you look at it from a whole system perspective. And yeah.
And as we look at these weakest link moving parts, 5 parts moving, 1 part breaks down, the whole machine breaks.
Yeah.
Are there certain patterns in which of those moving parts tend to break down first, or is it actually random which part will break?
Well, in his explanation, Jared Diamond, when he describes the Anna Karenina principle in his book Guns, Germs and Steel, he says that Tolstoy wrote that every happy marriage is alike, but every unhappy marriage is unhappy in its own way, right? So we have many, many different ways of how to fail, and I think it's very difficult to get a concept or a framework of how they fail. I think it differs a lot between individual cases.
So help us understand how you start to dissect a Lollapalooza. How do you identify these confluence of factors when it's only one output? How do you start to unravel this mystery?
Well, I just try to get as much worldly wisdom as possible by just reading all the time. So I'm really following Charlie Munger's advice to constantly read. And I think to get a good common sense and being honest to myself about what I can understand and what I can't understand. And of course, one of the most important models is to destroy or to try to destroy your best loved ideas and just really always have an open eye to find that weak link. And there are some concepts that help. For example, Warren Buffett says that if a high quality company fails over time, mostly there is some kind of complacency involved, right? So you recognize that the failure of success, right? You recognize that the company gets very successful and doesn't worry enough about competition, etc. So those are very, very dangerous indicators. If you observe that, then there is a related topic of bureaucracy. A company has always to be aware of the fact that there needs to be a lot of bureaucracy, like Peter Brabeck, the former CEO of Nestle, said that bureaucracy is like the skeleton. It's necessary to stabilize the company and the processes, but if you have too much bones in your skin, you can't move anymore. So getting the right balance there is very important. And if you observe that companies face reality, that's also giving you a lot of confidence. I mean, the world doesn't care about a single company. It evolves the way it does, and if a company is having the attitude that the world should move in a way with the company, which the company prefers, then it's all those things. It's about getting a critical mass of comfort and knowledge about a company, and you usually notice quite clearly if that's not the case. You get problems sleeping at night, and you get that you start to worry about one thing day after day, and so it kind of eats on you.
There's enormous wisdom in the principles you're sharing with us and the frameworks of how you approach these subjects. If it's appropriate to ask, could you share with us mistakes you made that you've learned from, or share with us successes that you've had which are based on skill as opposed to complete luck?
Yes. Well, the one thing I must admit here is that I did the first investment a little over 1 year ago. The first 3 years that I started as an investor, I basically just read and didn't do much. So the first investment that I can share it with you because I got rid of it quite a long time ago now, a few months ago. It was in Tesco, and I was very convinced that I got the analysis right. I got I got it right that Tesco is a cancer surgery, that many things need to be done there, that Dave Lewis, the new CEO, was a very good surgeon, that he would perform in a high manner and really refocus the company on what it did best, on the reasons why it got successful in the first place. And I also think I got it right that retail is a very slow-moving business. You don't have an immediate inflection point there. Market shares develop in a quite stable way, even though there is a lot going on. So I think I got the most important things right, but I really missed out on the valuation. I paid way too much for the investment, and when Dave Lewis announced this huge property write-off of around 50% of the equity base, and I realized how much money got reinvested in a very unprofitable way, I recognized that I totally overestimated the potential future earning power of a healthy, revitalized Tesco. And so I had to sell the investment. It was a very gratifying experience because I made this big mistake and could go out of it without getting a significant loss on the investment. I sold it around 240 pence, and then it got down to 140 or something. So I was very, very lucky having recognized that early enough. But it was a lesson. It was a big lesson.
You're using language of cancer surgeon, removing the cancer. That's actually those are the exact words that Munger used in his speech. I assume it's not a coincidence. I'm assuming that you found that mental model through Charlie Munger.
Sure, yeah.
Could you share with us more of what that model is, please, that you're describing?
Well,
I believe
the best way,
Munger called it the perfect turnaround, I believe.
Maybe not in his book, The Poor Charlie's Almanac. He just basically says what he watched during his long experience as a businessman. Time and time again, he saw how businesses who were once good at something kind of lost their focus, started to invest in fields where they didn't have a special advantage, and they build up that cancer that had to be removed. And then a person comes in with the right mindset and the ability to remove that cancer and refocus the business on what it did well over time. And that's a very effective way of making profitable investments, I guess, if you get the price right. I think it's very important that you don't pay like you would pay for a high quality company.
And if we talk about Tesco, do you believe that there was cancer that was isolated, and do you believe there was surgery that was done correctly?
Exactly. I mean, that were exactly the two questions that I always asked myself during the few months that I owned that company. The most important question was if the cancer is removable. So I really thought about that a lot, and there was not a clear-cut answer. In my analysis, the reason why Tesco got successful in the first place is because it focused better on customers, on the mix between convenience, price, and selection that a customer wants, and that's why they gained a lot of market share and advanced to around a 12% market share advantage compared to its second biggest competitor. So it was very clear that they did something better over time, and I thought that they didn't lose the ability to do that. And what they lost is they didn't do it anymore. They kind of started focusing on the international expansion, neglecting their core business in the UK and reinvesting a lot in the international expansion. That proved to be very, very unprofitable. Also with the US, they kind of wasted a lot of money on that attempt to get a foothold in the US. So I really thought that the basic competitive advantage would still be there when Tesco decides to refocus. And what I'm very convinced of is that the new CEO is the perfect guy to do that. So there is no doubt about that. I'm totally sure.
And help us understand what the cancer was, please.
Well, it has been a few months that I really dived deep into that analysis. There were many aspects of it. In the UK retail landscape, after the financial crisis, it got quite tough. So there was increased competition in the UK, and Tesco probably recognized that it's not easy to defend the old margins, right? So there was a lot of pressure on margins, and they would have needed, if they would have faced the reality in the way that I would imagine a high quality business to face reality, they would have probably decided to reinvest a lot in the UK business, reinvested in lowering prices, getting the customer offer better, and that would have lowered margins. But what Tesco's management decided is to kind of focus on margins, making sure that they reach a certain level of margins, and kind of got involved in many activities that allowed Tesco with the short term to get those margins, but kind of decreased the overall quality of the business. For example, they made suppliers pay for certain places on the shelves in their stores instead of focusing on what products the customers want to buy. And if you focus on what suppliers want to sell and not on what customers want to buy, you kind of lose the basic focus on what a retailer should get right? If you focus on the virtuous circle that a retailer is really dependent on, it's that it knows what the customer wants, it buys that from its suppliers, it gets the revenue, it reinvests that in lower prices, etc., all the things a customer wants. And this is kind of a virtuous circle that evolves over time. And they kind of engaged in activities that got that virtuous circle and put that in danger from turning into a vicious circle. And that's quite the worst thing that you could possibly do as a retailer.
And that was clearly isolated. It sounds like they were able to cut this cancer out.
Well, in my interpretation, it was basically a failure of management, a failure of getting the right focus. It was not an institutional failure. So I kind of, if a person is very good at something and he fails to get his focus right, and you still think that after those few years where he didn't do it, he would still be able to do it if he gets it mentally right, if he knows what to do, if he kind of refocuses again on what's important, then it's. But there are people, and I think there is some truth to it, that they can also say it was a cancer that was deeply involved in the business because the past management kind of grew up in the business and kind of represented the culture of the business. And if that was the case, it would have been. If that was the case, you wouldn't observe right now that Tesco is kind of stopping its market share from being lost, that customers really start again to go back into the stores, that every key metric of the operations is a lot better than it was 1 year ago. And that kind of, I'm even more convinced today that it will be a successful cancer surgery, but I know now that I should have paid a third of what I did pay.
So there's actually two separate things to talk about, but first there's the three steps. There's cancer that's isolated. It could be, or there's cancer number one, it's isolated number two, and a surgeon knows how to get rid of it number three.
Yes.
So how did you...
And there is no inflection point in the industry that kind of makes the skills obsolete of the company, right?
Okay, so how did you gain comfort that the surgeon was the right surgeon to do surgery?
Yes, that's a good question.
Was there a particular element in the biography or a particular compensation nuance or some nuance that people have to really, really see and understand to respect it?
Yeah, well, one important thing about that was that Dave Lewis worked for, I guess, a little over 30 years for Unilever. Unilever is a high quality company in my eyes, behaving in a high grade manner, and he probably would have been a serious nominee for the CEO position in Unilever, but decided to go to Tesco because he was convinced that a cancer surgery there is possible. He didn't use those words, but he clearly said that he thinks that Tesco still has unique strength on which he can build. And he always communicated very, very clearly about what he is going to do. And he did that, so you could observe the steps he took and the changes he made in the business. And it was just a very, very credible person who performed very consistently and did the right thing. It was all, I listened very closely to what he said at investment presentations, what he said in interviews, what he did. I just observed every single move that I could get my hands on. I think that gave me the confidence that he is the right guy.
And when you have the intellectual honesty to say you paid 3 times too much, you should have paid 1/3 less, how do you come to this conclusion? And how do you come to such a particular 1/3 and not 1/2 and not 1/8? How are you learning the lesson of 1/3?
Well, many people tell me that I'm focusing too much on returns on equity, for example, and I kind of, in my valuation, I focus a lot on the return on equity that a company generates. And I guess that in its best times, Tesco got a return on equity of a little over 15%. I know that Walmart is by far the biggest and probably also most profitable food retailer in the world, getting around 18%, which recently got under pressure because of wage increases and reinvestments into the online business. So I certainly would not expect Tesco to get as profitable as it was before the surgery. But I would consider something around the 10% return on equity as realistic. And based on that, I would pay something like 1.34 times book value. And if you look at the new book value, etc., you get around a third of what I paid for it.
And I'm always trying to understand that ROE obviously requires a book value calculation. ROE inherently is impacted by capital structure, if there's debt, if there's cash. So how do you contemplate if the balance sheet of Walmart is similar to the balance sheet of Tesco, and if there were to be more leverage, the ROE might be higher, and that might impact the price to book you're willing to pay. How do you compensate or calculate? How do you adjust for the capital structure and adjust for the fact that book value could be very different depending on how people do their accounting even?
That's very true. I mean, I obviously did a huge mistake with thinking how big, with my estimation of Tesco's book value. I mean, I don't think that Walmart in half a year will announce that 30% of the space it bought cannot be used in a profitable way and therefore needs to be written down. So I guess I got that totally wrong with Tesco. I couldn't imagine how much money they reinvested in an unprofitable way in additional store space, for example. But just to answer it in a more general way, I kind of always look at the return on unleveraged net tangible assets, which Warren Buffett calls the prime indicator of economic goodwill. You kind of get that by adding financial debt to equity and subtracting excess cash and intangible assets from that number. So you get like a picture of what the company earns on its basic operations without what it paid out for acquisitions or without what it keeps reinvested in the business. So you kind of see what the company earns on its operations, and with the return on equity, you see what does the management do with that. You know, how much money does the management decide to reinvest into the business? How much cash reserves does it keep in the business? How much does it pay for acquisitions? How much leverage does it take on? So this shows you how you get from the return on unleveraged net tangible assets to the return on equity by integrating management decisions into the operations of the business. And then there is an additional criterion that I recently discovered in the new book of Lawrence Cunningham. It's called Quality Investing. And your partner John wrote a little commentary in there in the beginning. So it's a very interesting book to check out. And they kind of introduce you to the cash return on total cash invested, which is also a very interesting number. And if a company doesn't cheat in its accounting, you get a similar result for all the different calculations.
So you're obviously adjusting for the debt and adjusting for the cash and adjusting for buybacks and adjusting for goodwill. So it's kind of an apples to apples comparison after all these different...
Well, I don't adjust for buybacks. I think it's like if a company engages in buybacks, it lowers your book value. If it pays out dividends, it lowers your book value. So I guess it's a similar effect. I don't adjust for that, but for many other things, yes.
And how did Tesco cross your eye? Was it through Berkshire getting involved, or was it through the fact there was this cancer surgery, or was it both?
It was I read in the newspaper how cheap it got, and that's where I got interested in it. And Warren Buffett still got his involvement there. And it was also a very uncomfortable moment when he admitted his huge mistake. And I was invested in Tesco, and I really tried to find a reason why he called it a huge mistake. And I knew that, okay, obviously he didn't foresee the amount of trouble that Tesco got in, but he should stay invested as long as he thinks that the price he paid from now on is profitable going forward. So I really tried to figure out why he sold the investment at lower prices than he got in, why he decided that that wouldn't be a good investment at that point of time. And obviously the answer was that many assets that I thought were there just were not profitable. So my whole estimate of earning power and sales and whatever was based on a too optimistic assumption about the productive assets.
Yeah, so based on all these experiences and insights, how have you been able to improve your process and to learn from the experiences?
Well, one big takeaway was never overpay for cancer surgeries, kind of be very focused on what you pay. And besides that, I don't usually engage in cancer surgeries. That was kind of, I kind of departed from my usual focus on high quality companies that really get the things right and not on cancer surgery. So I kind of, with my current holdings, I feel way more comfortable that no such surprise will just show up out of nowhere. I think if you get a consistent earnings record, consistent track record, and you have management behaving in a high grade manner and really knowing what they're doing, and having paid a reasonable price with a margin of safety in it, I think the chances of getting surprises that really destroy your value calculation, those chances are quite low. So I hope it doesn't happen in the next few days.
We're really so lucky to have you share your insights with us and so much of your time with us and so much of your honesty and candor as well. Thank you for being here. We hope to talk to you in the future.